Hi you guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. There's been a lot of talk out there lately about a coming stock market bubble in 2021. What do you guys think? Is the stock market going to crash again? What do I think? I don't know. Maybe. There's a lot of indicators out there. The stocks are overvalued. If you look at some of the headlines, is the stock market about to crash? Stock market bubble, the warning sign, a storm is coming. Let's see. Even Warren Buffett's favorite market indicator soars to record high, signaling stocks are overvalued and a crash may be coming. So if Warren Buffett can't tell for sure, but he thinks maybe, hey, it's possible, right? It could happen. Nobody knows. They thought last year we were going to have a big crash, remember? They thought with the pandemic that everything was going to go crazy and everything was going to be recession, and we had a pretty good year. So is it going to happen? You guys, I don't know. I wouldn't pretend to know. I'm just a guy on the internet who likes to invest, but I don't know. And half the professionals out there tell you one way or the other, and they don't really know either. So today I thought I would talk about what you can do if a bubble or a crash does come. And I'm going to talk about 4 things, and 3 of them are things I think that you need to do, and one of them is kind of a bonus. You guys, the first thing you need to do is have an emergency fund, because the big thing that happens when the stock market tanks is other things happen badly, right? We have recessions, we have higher unemployment. So we have people without jobs, and you lose your job at the time when the stocks are down. Having an emergency fund for little things, right? Now I realize some people can't save up 6 months of expenses, but you guys should have at least try to have 3 months so that if you do lose your job when the economy's bad and stocks are down, that you can survive. You could think about it. If you lose your job, then your car breaks down. Now you can't go out and find a new job. These are the things that we keep an emergency fund. I know cash is giving us zip. Nobody wants to hold cash because it's not worth anything. But I feel like the emergency fund is the one amount of money that you need to have in cash. It needs to be readily available so that if something bad happens, you can get it within a day or a day or two, right? Quickly. So this is liquid cash in either an online savings account, a checking account, what have you. Okay, the second thing I think everyone needs to do is, first of all, control your emotions. Now, that's easy to say that when I'm not gonna panic when it dips, I'm gonna buy, but human nature has shown us that's not really what happens. A lot of people will pull themselves out of the market and go to cash because they're afraid they're going to lose more. And it's understandable because it takes a long time for you to build that money up, right? So when you see it going down, of course you're going to be upset. Of course you're going to panic. Of course, this is human nature. It happens to everyone. But you guys, here's a little story. If we use history as an example. Now, past history doesn't guarantee future returns. I know that. But I have a graph here, and we're going to take a look at it really fast. This is the S&P 500 for the last 30 years, you guys, from 1991 to 2021. If we look at the beginning here, on March 22nd, 1991, we see that we were at 367.48. Today we're at 3,921. So we've increased the market in 30 years tenfold. But let's take a better look. We see that it's going up through the 90s, right? And we get up to just about 2,000, and we're at about 1,500. So over the decade of the 90s, it basically tripled. It went up 5 times, 500%. And then we see the dot-com bubble, and we go down to about 2003, and we see that we're back down below 1,000. So they lost about 500 points in that crash. That's when a lot of guys that thought tech was going to be everything lost everything. And then we look, it started slowly going back up. We get up to about 2007, and we're back to a little bit above where we were in 2000 when it crashed. And then came the Great Recession, as we all know, right? the banking system almost collapsed. And we dropped down once again below 1,000. And then 2009 came and things started turning around. And if you can see, we've been on a steady meteoric rise since 2009. But if we look closer, we can see there were some little buckles in there. In 2015, we had a little correction of about 20%. Then you go forward to about 2018, and we had a big correction at the end of 2018, right? That was, they thought was going to be another crash, but it corrected. And then we go forward and forward, and we get up until last year, 2020, March. Now we see as the market gets higher, these swings can become bigger and more volatile. But as you see, after that corrected, we are at all-time highs, which is why everyone thinks we may be on our way to another bubble. Are we? As I said, I don't know, you guys. But what can we do? We can think about this. Over any 20-year period in the history of the stock market, since it started, we've always had a positive return. And in most cases, every 10-year rolling period had a positive return. So if I'm a young guy in my 20s, 30s, or even my 40s, I'm not really concerned about it because I know that historically the stock market wins out. If I wait that 5 to 10 to 20 years, I'm going to make money, right? So using history to reinforce our psyche can help us stay the course and not sell. The worst thing we can do, you guys, is sell. All right, so that brings me to my number 3 thing, and that is simple. If you have a workplace plan and you're contributing every paycheck, so let's say you get paid twice a month, right? Every 2 weeks, they're putting some money into the stock market for you in your 401k, your 457, your 403b, your TSP if you're in a government employee. Whatever it is, you guys, it's automatically going in. So what is that doing for you? It's not only buying it now when it's high, but if it dips down, it's buying those on the low, right? Your dollar cost averaging. It's actually smoothing out the ride for you by doing nothing. You've already got that. If you're contributing to a Roth IRA, let's say you put $500 in every month so that at the end of the year you'll have your $6,000 in there total, right? By putting that $500 in every month, you're buying whatever it is each month. Again, dollar cost averaging. So some months are going to be high, some months it's going to be down, you're going to be buying lower. It's on autopilot. You don't have to think about it. That can reinforce your mind that, hey, I'm not just buying when it's high, I'm buying all the time, whether it's high, whether it's low, wherever it is. That can add to helping you with number 2, right? Controlling your emotions. Emotions are a big problem because what happens is you freak out and you sell, but when do you get back in? You're afraid to get back in too early, and then you wait until it's at all-time highs, and now you missed out on all the gains you would have had if you would have just left it alone. The 4th one is kind of an extra, you guys. For me, this is not a necessity by any means, but if you're doing well right now, you guys put away a little extra cash. As we said, cash is not giving us squat. It's terrible, right? We know cash is at best going to get us 0.5%, right? We put in $100, we get 50 cents at the end of the year, end of the month. It's I know that, but here's the thing: having a little cash, even if you have it in an investment account, say in your settlement fund, or you have it in a money market fund, having it available so that if it does go down, say 20%, you can take some of that money, dry powder as we call it, and buy some stocks while they're on sale. This is another way to reinforce you that, hey, I don't have to worry about this going down. I'm going to take advantage of it being on sale. Now here's an example, right? If you buy a house, let's say for $200,000, and somebody offers to buy it for $150,000, you'd tell them to take a flying leap, right? You'd say, no way, I'm not going to do that. That's dumb. So why do we do that with stocks? We have $100,000 in stocks. They drop down to 75. We want to sell because we don't want to lose anymore. This is where the problem becomes. So having that dry powder, that extra money put aside, and it doesn't have to be much, you guys, but buying them on sale when it does start to return, is going to actually make you more money. This is why rich people do well, because they don't panic. It's on sale. Don't go to cash. Use some of that cash you have set aside and buy more. Now, obviously, none of us know when the bottom is, right? And I'm not going to try to tell you that on this day, when it gets to this much, you should buy. All I'm saying is, if stocks are at $100 now, let's say, just for easy math, and they drop down to 80, I want to buy some at 80 because I'm getting 20% extra for free. Now, that's an individual choice. You made choice to buy a little bit at 10% down or 15% down. I don't know. Investing is an individual journey. You have to make your own decisions, you guys. And I certainly am not the guy to give you the advice on when to buy or when to sell or any of that. You know my position. My position is never sell. If you are buying stocks, the easiest way is an index fund, right? Because then you have a big basket of stocks. You don't have to worry about it. Just keep putting money in, let it ride. Most times, you're going to end up winning the race that way. Don't let a bubble or a crash or whatever the CNBC wants to call it this time. They'll come up with some neat name, Coronamageddon, I don't know. You guys, keep your heads. Have that emergency fund. Keep your contributions going on a regular basis, just like you do when things are going well. And if you have a little bit extra put aside, maybe you use that when it does dip to buy some more. You guys, I hope you got something out of this. If you did, do me a favor, drop me a like. It really helps the algorithm. If you're not already subscribed, you know the deal. Hit the red button, ring the bell. You'll get notified whenever I can make another video. All right, we'll see you. Thanks a lot.